Welcome to the Riskwiser Zone. I'm your host, Louis. Today, we're diving into the world of alternative assets and their growing appeal amidst market volatility. We have two key stories to discuss, both of which highlight the shifting landscape of investor preferences. Firstly, the Securities and Exchange Board of India, or SEBI, is planning to simplify the process for real estate investment trusts, or REITs, and infrastructure investment trusts, or InvITs, to issue debt securities. This move aims to make it easier for these trusts to raise capital and could potentially boost their attractiveness to investors. In related news, investors are showing a stronger interest in REITs and InvITs compared to traditional initial public offerings, or IPOs. Over the past 3 months, we've seen several successful issuances of these investment trusts, with subscriptions ranging from 5 to 23 times the offer size. This is in stark contrast to traditional IPOs, which have been experiencing a dry spell. Experts attribute this trend to the stable and predictable cash flows offered by REITs and InvITs, making them more appealing in uncertain market conditions. With returns typically ranging between 13–15%, these alternative assets provide a relatively safer bet for investors seeking regular income. As one expert noted, REITs stand out in shifting economic cycles because they are fundamentally backed by annuity-style rental streams from high-quality commercial assets, offering investors a combination of predictable yield and potential capital appreciation. It's clear that investors are becoming increasingly drawn to the stability and resilience offered by alternative assets like REITs and InvITs. As we navigate the ups and downs of the market, it's essential to stay informed about these emerging trends and their implications for our investment strategies. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of corporate earnings and financial reports. Today, we're looking at a series of companies that have recently released their Q1 2026 earnings calls, from Cronos Group Inc. to Kaltura Inc. These businesses are navigating complex markets and sharing their insights with investors. Let's start with Cronos Group Inc., a Canadian cannabis company. Their Q1 2026 earnings call highlighted the challenges they're facing in the industry, including regulatory uncertainties and intense competition. Despite these hurdles, the company remains optimistic about its future prospects, citing growth opportunities in international markets. Next up is Kaltura Inc., a video technology company that's expanding its reach in the digital landscape. Their Q1 2026 earnings call focused on the company's efforts to drive innovation and increase revenue through strategic partnerships and product development. With the rise of remote work and online learning, Kaltura sees significant potential for growth in the video platform market. We're also seeing interesting developments from other companies like Simon Property Group, Cronos Group Inc., and Kaltura Inc. These businesses are adapting to changing consumer behaviors, investing in new technologies, and exploring fresh opportunities for expansion. As we analyze these earnings calls, it's clear that each company is facing unique challenges and opportunities. While some are struggling to maintain profitability, others are leveraging their strengths to drive growth and innovation. One thing is certain: the business landscape is constantly evolving, and companies must be agile and resilient to succeed. Welcome back to the Riskwiser Zone. As we approach the end of our show, I'd like to take a moment to discuss a pressing topic that's been making waves in the financial world. You may have heard about the recent surge in tech stocks, particularly those related to artificial intelligence. While some investors are riding high on this trend, others are sounding the alarm, warning of an impending crash. One such voice is Michael Burry, the infamous investor who predicted the 2008 housing market collapse. He's now cautioning that the Nasdaq 100 index is trading at unsustainable heights, with valuations reaching as high as 43 times earnings. Burry likens the current market to the peak of the dot-com bubble just before it burst. Now, I know some of you may be thinking, but Louis, what about all the excitement around AI? Isn't this a legitimate growth area? And you're right, it is. However, as Burry and other experts are pointing out, the current valuations may not be justified by the underlying fundamentals. The Philadelphia Semiconductor Index, for example, has surged nearly 70% since the end of March, leaving some to wonder if this is a case of irrational exuberance. As always, it's essential to approach this situation with a level head and a critical eye. While it's possible that the market may continue to rise in the short term, it's equally important to consider the potential risks and consequences of a correction. Burry himself is advising against shorting stocks, given the expense of put options and the risk of being burned by ill-timed trades. Instead, he suggests taking profits from the recent rally and reducing exposure to stocks, particularly those in the tech sector. So, what can we take away from this? As the first always say, it's crucial to be aware of the potential risks and rewards in any investment. While it's tempting to get caught up in the excitement of a rising market, it's essential to maintain a disciplined approach and avoid getting swept up in the hype. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.